Now we are going to study profit margin scheme under the UAE VAT law. So, what is profit margin scheme? In accordance with the profit margin scheme, a VAT registered supplier can account for VAT on the basis of the profit earned on taxable supplies instead of accounting for VAT on the total value of the supplies, provided certain conditions are met. In other words, under the profit margin scheme, VAT can be accounted for based on the difference between what was paid for a good at the time of purchasing it and what was charged to the customer at the time of selling it. In this instance, the difference, uh, let me change the view. Right. So in this instance, the difference, that is the profit, is treated as being inclusive of VAT. So basically, the amount of money that a taxable person paid to acquire the goods minus the consideration that he charged and whatever the margin that is seen as inclusive of the VAT. The profit margin scheme is intended to avoid the cascading of taxes. The cascading effect arises where a VAT registered supplier purchases a used good from a non-registered seller. So a VAT registered supplier purchases from non-registered seller or from a seller who also accounted for VAT by reference to the profit margin scheme. And consequently, the VAT registered supplier is not able to recover the VAT embedded in the price of the used good. So that's we'll see there are quite a few conditions attached to it. Let's go through further. A VAT registered supplier may calculate the VAT on profit margin instead of the full value of the supply in the case of qualifying goods only. Now, qualifying goods must be bought by a taxable person from, first of all, a person not registered for VAT or a taxable person's business where VAT was calculated on that supply under the profit margin scheme. So it's not only the profit margin scheme is not only applicable where the taxable person purchases something from a non-registered person. The taxable person can purchase goods from a taxable person's business also, but the condition is that taxable person's business should have also accounted for the VAT under the profit margin scheme as an alternative to condition A, which is the two categories, where the taxable person made a supply of good for which input tax was not recovered in accordance with Article 53 of the regulation. So that is also possible where a taxable person made a supply of goods for which input tax was not recovered in accordance with Article 53 of the regulation. So any goods that was purchased from a non-registered person. As outlined in Article 29 of the regulation, the goods must have been subject to VAT before and must fall into one of the following categories to be regarded as qualifying goods for the purposes of Article 29 of the regulation. Second-hand goods, meaning tangible, movable property that is suitable for further use as it is or after repair. So basically the biggest category is second-hand goods. Uh, those goods also could be second category antiques, goods that are older than 50 years. And another category, collector's items, meaning stamps, coins, currencies, and other pieces of scientific, historical, or archaeological interests. So these are the categories which which will be referred as the qualifying goods under the profit margin scheme. FTA must be notified if the registrant used the profit margin scheme in a tax period. Using the scheme without notification may result in the imposition of an administrative penalty. So there is a notification requirement. Note, the notification to FTA is done via the VAT return by selecting yes in the relevant field. So if you look at the Imara tax portal where you find the VAT return, there is a caption called profit margin scheme, and with a yes no options. So in that caption, yes has to be clicked. If a taxable person applied the profit margin, the supplier is required to issue a tax invoice that clearly states that the tax was charged with reference to the profit margin, and the tax invoices should reflect all the information required under Article 59 of the VAT Executive Regulations, except the amount of tax imposed. So it should be net of the tax. And there should be a proper tax invoice for goods that are purchased and sold under profit margin scheme. Under the profit margin scheme, a VAT registered supplier can calculate VAT based on the profit made from the taxable supplies rather than on the full value of those supplies. This means VAT is accounted for on the difference between the purchase price of the good and the selling price to the consumer. Note, the purchase price includes, in addition to the price of the good, any costs and fees incurred to purchase the goods. That has been provided in Article 29 of the VAT Executive Regulations. Therefore, the profit margin is calculated as follows: consideration received on sale minus consideration paid on purchase. Straightforward and simple formula. And the difference is taken to be inclusive of VAT. Let's go through an example. Uh, Joni sells antique furniture. She bought a Victorian dresser from a member of a public for AED 300 on 1 July 2023. She then sold the dresser for AED 900 on 30th August 2023. The dresser was originally bought in 2019 from a well-known departmental store in the UAE. Assuming Joni submits VAT return monthly, state the output tax and input tax to be entered on to Joni's VAT return in respect of the dresser. So what we will do is, uh, because this was a purchase from a member of public, naturally there's no input VAT on it, but we'll take the difference between the selling price 900 and the purchase price, which is 300. Difference is 600 dirhams. So on that 600 dirham, that 600 dirham will be seen as inclusive of VAT. So we will have to reverse calculate the VAT. So we will consider that 600 as 105% of the base value on which VAT is applied. And through that calculation, it will be less than 600. So the base price will be less than 600 and VAT element will be 5% of that base price. Goods not previously subject to VAT. FTA has issued a public clarification on profit margin scheme, edible goods. Okay. Public clarification on profit margin scheme on edible goods. The profit margin scheme may also be used in respect of goods which have previously been subject to VAT before the supply in question. So goods that have previously been subject to VAT. As a result, stock on hand of used goods which were acquired before VAT was introduced in the UAE or which have not previously been subject to VAT for other reasons are not eligible to be sold under the profit margin scheme. So what is not eligible to be sold? Stock on hand of used goods which were acquired before VAT was introduced in the UAE, before 1 January 2018, or which have not previously been subject to VAT for other reasons. They are not eligible to be sold under the profit margin scheme. VAT is therefore due on the full selling price of such goods. A supplier should be confident that the good was previously subject to tax in order to apply the profit margin scheme. So, supplier has to make sure that the goods that he's selling and claiming and reporting the VAT under profit margin scheme, they were previously subject to VAT in order to apply the profit margin scheme. Examples of evidence or information of this position could include, for example, information relating to the date the good was first manufactured, sold, or brought into use. For example, in the case of a car, the date the car was first registered would indicate its sale would have been subject to VAT if it was registered on a date after 1 January 2018. So that's an indicative evidence basically. Evidence that the supplier paid VAT on their original purchase, for example, by asking the supplier for a copy of the tax invoice relating to their purchase of the VAT. So if they purchased the item and paid tax on it, that will mean that uh, this good was already subjected to VAT. Throughout this study text and in your exams where an item is acquired by a business in a scenario where the profit margin scheme is relevant, you should assume that the item has previously been subject to VAT unless you are given specific information which indicates that this is not the case. Now, what about records? If a taxable person opts to apply the profit margin scheme, the following records must be kept in respect of the supplies made under the profit margin scheme. Again, this is Article 29 of the VAT Executive Regulations. A stock book or similar document showing the details of each good purchased and sold under the profit margin scheme, purchase invoices showing the details of the goods purchased under the profit margin scheme. If the goods were acquired from a non-registrant, meaning someone who's not registered for VAT, the taxable person must issue an invoice to them to themselves. That's a very important and interesting point. So that invoice will be issued to themselves. Such invoices must include at least the following information: the name, address, and the tax registration number of the taxable person, the name and address of the person selling the good, the date of the purchase, the details of the goods purchased, the consideration payable for the purchase, and the signature of the person selling the good or an authorized signatory. So all of this information should be available for supplies made under profit margin scheme. There's another example, which is Lucas, a VAT registered taxable person, buys a vase from Hamad, who is not VAT registered. Lucas sells the vase for a profit to Leila, a private individual, right? Lucas, a VAT registered taxable person, buys a vase from Hamad, who is not registered for VAT. For an unregistered person, sold it. And Lucas, who himself is a VAT registered person, he later on sells the vase to a at a profit to Leila, who is again a private individual or a member of public. Assuming that Hamad incurred VAT when he acquired the vase, provided the above meets the conditions for the profit margin scheme, for each transaction under the profit margin scheme, state whether a tax invoice is required, and if so, who is responsible for producing this. So you know, the first of all, there's a purchase transaction. So the fact that Lucas had purchased it from a non-registered supplier, non-registered supplier cannot raise a tax invoice. It will be a simple, commercial invoice, if at all, right? So that will be but the evidence will need to be there for uh, that purchase. So at least an invoice will be required from Hamad, who sold originally the vase. However, later on, because Lucas sold it to another person, that's where the tax invoice will be needed. So Lucas will have to raise a tax invoice to himself, even if he doesn't give it to Leila. Um, and that tax invoice will contain the will contain the sales price, the proceeds of sales from Leila, minus the cost that he incurred on purchasing that vase, and the difference will be the margin, which is inclusive of VAT. So there will be a reverse calculation. We will treat that profit margin as 105% of the value of supply, and then we will get the amount of VAT as well, and that will be included in the tax invoice. That was an overview of profit margin scheme under VAT. Thank you very much.